I want to begin the bulletin with the latest inflation numbers from the Ghana Statistical Service. Inflation for the month of February declined to 52.8% from 53.6% in the month of January. The Ghana Statistical Service is attributing this to a drop in the cost of transportation as well as non-food items. Let's take a listen to government statistician Professor Samuel Kabnenim address the media.
Consumer Price Index for the month of February 2023 stood at 168.7 for the month of February 2023. This compares with the Consumer Price Index of 110.4 for the month of February 2022. Given these two price indices for the month of February 2023 and February 2022, inflation for the month of February 2023 stood at 52.8%. This indicates that prices of goods and services on the average between February 2022 and February 2023 have gone up by 52.8%. That is, prices of goods and services over a one-year period, specifically February 2022 and February 2023, went up by 52.8%. We have sustained the reversal that we started in last month with the upward increase in inflation. It will be recalled that in January 2023, we had a reversal of the upward trend from 54.1% in the month of December 2022 to 53.6% for the month of January 2023. So we have sustained the reversal in the upward trend in inflation rate that we recorded greater part of 2021 and 2022. The difference on a year-on-year basis between January 2023 and February 2023 indicates that prices of goods and services went down by 0.8 percentage points between January 2023 and February 2023. On a month-on-month basis, contrary to the sustained reversal, we saw Consumer Price Index on a month-on-month basis inching up by 0.2 percentage point, as the 1.7% that was recorded in January 2023 went up by 0.2 percentage point for the month of February 2023, increasing to 1.9% for the month of February 2023.
Well, joining us to make sense of the latest figures, Courage Botie, who is an economist and research lead at GCB Capital. Thanks for your time, Courage. So where are we at in our quest to bring down inflation based on the latest figure we have now for the month of February?
Well, good afternoon to your listeners and yourself. Yes, I think it's impressive. We've seen another marginal decline in inflation for the month of February. It is significant because of the period where we've seen revenue interventions kicking. Specifically, government increased VAT by some 2.5%. That took effect. The complete reversal of benchmark policy, that means that imported goods no more have the benchmark discount values, also took effect. From February 1 also, I think the increment in water and utility tariffs also took effect, which means there was quite some price pressures around that period that could affect inflation. You saw that reflect in the headline month-on-month inflation and then headline non-food inflation for the period, with the headline month-on-month increasing by some 20 basis points to 1.9%, while the non-food figure also increased by some 80 basis points for the period. But for overall inflation, it was an 80 basis point decline for that period, which goes to tell us that the price pressures that we saw from the beginning of, I think, sometime May 2021 all the way till now are beginning to soften a bit. Particularly, the main triggers, I believe, have been exchange rate depreciation and fuel prices at the pumps. For this period, we've seen that some interventions on the local market, and then, of course, the easing of crude oil prices on the general market, global market in general, meant that we are not having as much pressure from export prices. And in particular, CD, even though not exactly stable, have behaved within a certain range so far this year, which meant that the depreciation problem is not so much pronounced. And we are seeing all of it in part reflect on relatively stable transport fares, stable fuel prices at the pumps, and relatively stable prices on the market compared to what we've seen in previous months and weeks, really. And I think these are the things setting inflation on that downward trend. I wouldn't say we have reached a peak yet, because some of these revenue interventions could have lagged impact. Maybe that could run over the next 2-3 months, especially for the February data window, which did not reflect all of these interventions really. I would be cautious to say we've reached a peak. You want to observe the trend over the next 2 and 3 months to see the clear trend that is emerging. Then we can conclude on whether 54.1 was the peak point of this wild inflation run.
Yeah, because I was wondering about the rate of decline. Yes, inflation is going down, but could it be faster? Is it going down as fast as we would have anticipated?
So, well, you could safely argue from the arguments I've advanced so far that inflation decline could have been faster than we've seen, the 80 basis point we've seen in February, but for some of these revenue measures, really. And until we incorporate their full impact and lag impact, really, you might not see very sharp declines in inflation. I understand there is a base pull effect, and it will get stronger as we go on. But we have to see the effect of these revenue measures actually fully reflect, and then you can begin to see the full impact of some of those base drift. And going forward, hinging on the IMF, if the cedi gains more stability and then oil market behaves the way it ought to behave going forward, with all of the interventions coming from within and without, really, then we could begin to see sharper inflation going forward. But the trend seems to be positive now, and it can only get stronger as the effect of the revenue measures that we've seen reflect in February decay.
And so from the perspective of government intervention, are they on track in bringing down inflation?
Well, I think the major thing government has done so far to try to affect fuel prices directly has been the goal for oil policy. It's a temporal measure, and I think the plan, so as I've heard it from the authorities, is that they intend to meet half of our national oil import, which I understand is valued around some $4 billion annually. They want to meet half of that. Now, if we can achieve that, then you could begin to see its impact on prices on the market, because the depreciation effect will not be transmitted fully, and you are having a government-to-government arrangement, which potentially could mean that you are not especially exposed to the fluctuations in the oil market as much as you would have it. And the interventions from the Bank of Ghana, at least from the BDC's forward auction, would also mean that we are bridging the FS gap a bit, which could reflect in reasonable prices or reasonable increases at the pumps relative to the sharp ones we've seen. And so to that extent, yes, I think there is some intervention in there. But most importantly, around this time, I think one of the triggers of inflation for 2022, beyond every other thing, has been the monetization of the deficit. We've seen about 43 or so billion central bank deficit financing last year. In this particular year, with the IMF on the horizon and all of that, you do not expect a lot of monetization of deficit this year, if any at all. Plus, at the moment, the domestic banking sector is awash with liquidity. And if those liquidities are not channeled to the appropriate sources or are not mopped up adequately, it has the potential of triggering inflation also. So I look forward to the March inflation monetary policy meeting and what decisions will come out. The expectation will be that there could be some marginal hike again, maybe 100 basis points, just to channel some of those liquidity in the banking sector into reserves and into the central bank, so that we limit its impact on inflation, especially now that banks have mostly adopted a cautious stance to loan book growth, really, given everything happening in the sector. So if we coordinate and synchronize those fiscal and monetary policy interventions properly, we should begin to see a much sharper decline in inflation going forward.
I want to switch topic and quickly ask you about the decline in T-bill rates. We've been discussing this in the last couple of days, and depending on which analyst you speak to, they say it's good or bad. Government's move to force down interest rates on treasury bills. Where do you stand on this?
Well, I don't think it's a question of good or bad. I think it's a question of what is prudent. Let me give you an instance. If you did domestic debt restructuring with the aim of saving interest costs because your fiscals are rigid and you do not have a lot of space, and interest cost alone was going to consume about 52 billion out of your total revenue you expect in 2023, and you have successfully slashed bond coupons from the average 19.5, 20% levels now to between 8.35% and 10% going forward. It is only natural that you bring down T-bill rate, and the 35% levels that were being given is not sustainable. It won't even help government realize the interest savings from the domestic debt exchange. So it was only natural. I think it was problematic when they were accepting everything tendered on the T-bill market and the rates they were being tendered. That sustained the rates where they were. Now, the government, I believe, have shifted to the strategy where they will guide the market down gradually, and they will do so by rejecting bids they consider far outside the range. It is working because at this moment there is so much liquidity in the banking sector, and there are limited options for fund managers and investors in general beside T-bills at the moment. And so you have the leverage or the room to achieve that and force it down quite sharply. You need that to realign the market. This moment in time, most of the fund managers are unable to sell bonds to fund withdrawals from their clients. And the reason is the secondary market is non-existent. For as long as T-bills are offering 35, 34 and things in that area, you won't see activity on the bond market. So it's actually imperative for us to realign the market, bring back activity to the secondary market for bonds, and then you can effectively stabilize the market and ensure that the money market is working, bonds market is working, and then every other thing related is working so that the market can rebalance appropriately to restore normalcy from the shocks we've seen last year.
But there are some analysts who suggest that the decline is not backed by the current economic trends. The explanation is that, well, for the interest rates to drop, then we should see a significant drop in inflation. Otherwise, we're creating a problem for ourselves. And the fear that investors may turn to the US dollar, and then that will consequently strengthen the dollar. You know the implications on the cedi. Your thoughts?
Well, that argument is sound. I won't begrudge it, except to say that we are not in normal times, right? Inflation is 54% and now 52.8%. But it was there because of the abnormality in the system, right? And in any case, at 34, 35%, we were not having positive real returns anyway, right? Because inflation was still much higher. You compare ourselves to countries like Nigeria, Kenya, Egypt, and places like that, and they are running negative returns. T-bill rates are way below where inflation is. I think that is acknowledging the abnormality of the times we are in. And if we want to maintain positive real returns on these investments, really, then there was no point in even doing debt restructuring in the first place, right? And so I think we need to accept the abnormal times we are in, and that it will require drastic measures to try to keep the economy afloat. Then the rest can follow. On the exchange rate argument, yes, there is a possibility of that, and it is already happening. But that is where regulation needs to be strengthened and disclosures need to be strengthened so that we avoid such speculative tendencies, really. The Bank of Ghana has to do its job at this point. What we need at this moment is realigning the market, and the normal course of action can follow from there.
Courage, have you heard anything on the coupon payments for bondholders who opted out of the domestic debt exchange program? Our latest report was that the Bank of Ghana was in the process of finalizing payments to commercial banks. Any news from where you are?
Yes. I got news from friends and colleagues who are exposed to those there today that some have received coupon payment. Not that it will be paid, some have actually received coupon payment, really. So I think it's gradually coming to close now that those monies will be paid. Some people have actually received money already this morning.
All right, that's some good news to wrap up our conversation. Thank you so much, Courage Botie. Always fun to speak with you. Research lead at GCB Capital. I appreciate your time with us. Thank you so much.